Hey everyone, welcome back to Corporate Decoder, the place where we decipher corporate filings so you don't have to. Today we are diving into Guardant Health's latest quarterly report. Will this company, focused on early cancer detection, live up to its guarding wellness promise, or will the financial details reveal a different story? Let's find out. This is Guardant Health's Form 10Q, which is like a quarterly checkup on the company's financial health. It covers the period ending in March of 2025, giving us a look at how they performed in the first 3 months of the year. One quick thing to note up front. As of late April 2025, they had about 125.9 million shares of common stock outstanding. This number is important because it impacts earnings per share, and we'll touch on that later. Alright, let's dive into the financials. First up, let's take a peek at their balance sheet, which is like a snapshot of what the company owns, assets, and what it owes, liabilities. Looking at the asset side, cash and cash equivalents jumped significantly from about 525 million to 690 increase in their short-term liquidity. Their accounts receivable, which is money owed to them, also went up a bit, but not by much. It signals slow customer payments and collections. One interesting thing is that their short-term marketable debt securities disappeared. The marketable securities, which are low-risk investments, decreased, suggesting that they either use that money for something else, maybe to invest or pay off debt. Now, on the liabilities and stockholders' deficit side, their accumulated deficit, which is how much they've lost over time, also increased. That's not great. It means they're still spending more than they're earning. Overall, the total stockholders' deficit worsened quite a bit, going from a negative 139 million to a negative 250 million. This means their liabilities are outpacing their assets, not ideal. Let's move to the income statement, which shows whether they made a profit or loss. Their revenue increased to 2,003 million. Compared to last year, that's a solid jump, but that's not enough to make them profitable. We can see that they spend a lot on research and development, and that did increase. Basically, this means they are investing on what's next, but it also eats into their profits. Because of all these costs, their net loss per share, basically how much money they lost for each share, also didn't improve too much. Now, the cash flow statement is important because it shows the actual cash moving in and out of the company, which can be very telling. Looking at the net cash used in operating activities, they still spent much more than they earned and lost quite a bit of money. Investing activities actually boosted their cash because they are selling some of their investment maturities of marketable debt securities. However, when we look at financing activities, we can see a few things, which is they repurchase treasury stock. That means they are buying back their own shares, but not selling new ones. This can help prop up the stock price in the short term. Customer concentration is always something to pay attention to. A large percentage of their revenue and receivables come from just a couple of key customers. So they rely on a few clients for almost a third of their revenue. If they lose those relationships or one of those clients has issues, it would hurt them hard. Also, some non-mark table equity securities, those are investments in private companies, and because of how the investments are going, they also took a 5 million hit for one of those investments. When we look into things like fair value measurements of their assets like cash and money, what we can see is that they are based on quoted market prices and third parties. What this means is that those values are estimates that are easy to check. They also have something called acquisition-related contingent consideration, basically money they might owe for previous acquisitions depending on how those companies perform. These estimates rely on internal assumptions rather than outside values. The company has two sets of what are called convertible senior notes. These are like loans that can turn into stock, which can be a good thing or a bad thing depending on the stock price. They did some fancy financial footwork here, issuing new notes to pay off old ones and reducing the amount owed. This is a creative approach to manage their debts, but adding more long-term risk. One of the important notes here is that they saw a gain because of it. However, keep an eye on this, as this could signify underlying problems. The company's also dealing with a lot of legal battles. They are still fighting that intellectual property case with Twin Strand Biosciences from 2021, and they filed their own suits. This legal mess could take up a lot of time and money. We should also note that the company's top people, like their CEOs, have these special trading arrangements where they sell stock based on a preset plans. These arrangements are legal and there is nothing wrong, but it's something to pay attention to. Alright, let's zoom out and look at the big picture. Now, the biggest challenge and opportunity hinges on something called payer coverage and reimbursement. It's a fancy way of saying getting insurance companies to pay for their tests. That's what decides their profits, and without a good insurance, it will be hard. They also said they may need to raise money in the future to fund their growth. This means they might sell more stock or borrow money, which could affect the current shareholder values. We need to take a minute to talk about risk factors. There are two big ones: interest rates and foreign currency. Changes in interest rates and foreign currency exchanges would not be material. In simple terms, it is a good thing. What this means is that they are protected from fluctuations in the market rates. Internal control, so it means that everything is up to par in how they do things internally. This is a good sign because it means that they have good operations internally. Now, what's my take on all of this? It seems that Guardant Health is at a critical point. They're making more money thanks to demand on cancer diagnostic, but they are also spending like crazy on marketing and expansion and research. The biggest question is whether they can get tests covered by insurance. If they get a few wins on that front, that's a game changer. If not, those losses could keep piling up. The ongoing legal battle as well, that's something that could really sting them, especially if they end up having to pay a lot. All in all, Guardant Health is a high-risk, high-reward play. If you believe in personalized cancer medicine, this might be a stock to watch, but make sure you realize that it's not for the faint of heart. Thanks for watching. If you enjoyed, please subscribe, like, and comment.